Next area that I want you to think about, and it was mentioned earlier about in the District of Columbia, there is an unincorporated business franchise tax. That does not exist in the neighboring jurisdictions, Virginia and Maryland. It's something that we have to deal with. DC has been very business friendly in a lot of areas, but this is one area that people are quite surprised about. I think once or twice a year I get a call from out-of-town developers who've come here and done things and they've been surprised and said, what is this? So you need to pay attention to it. So capitalization of your business. Most all businesses, when they're formed, have to be capitalized. So the question comes, do you capitalize it with debt or equity? If it's capitalized with equity, it's likely that those profits on that capitalization will be subject to the unincorporated business tax. If you capitalize it with debt, an appropriate amount of debt, the interest payments on that debt will escape taxation under the unincorporated business tax regime and be taxed to the owners in their resident state. Now, if you're a DC resident, really no impact. In essence, the rates are basically the same. There's a 1% savings if it's taxed on the individual return versus the business return. But if you're a Maryland resident, the savings is about 3% or 30% overall of your state tax liability. If you're a Virginia resident, the savings are enormous. They're 6.5%, dropping from about 16.5% to 10% your overall state burden. So very significant. Another area or strategy that I think people ought to consider, and that relates to where you're doing business. And if you are doing business in more than one jurisdiction, and the way that the various jurisdictions determine if you are taxed in their jurisdiction is whether or not you have sales, property, or payroll in that jurisdiction. So let's assume that somebody operates totally all their businesses in DC, all their revenues come from DC, yet for some reason they don't have payroll and they don't have property, and they make $100,000 a year. They would have a DC franchise tax liability of $10,000. Now, if we change the facts just a little bit and say somebody then opened up an office and incurred payroll in Virginia or Maryland, and let's assume Virginia, for example, and still made $100,000 a year, you would have to apportion your income between DC and Virginia, because Virginia, you have an office and you have payroll, so they would want their share of income taxes on that. In that scenario, where you earned $100,000 and you had payroll and property in Virginia only, and all your revenues were in DC, your DC tax liability would decrease from $10,000 to about $3,300, and your Virginia liability would go from $0 to $3,000, an overall savings of about $3,600 or 3.6%. Fairly significant over a period of time. The last strategy, and this is really not to be self-serving, but if you're operating a business, I think it's critical that you hire a good attorney and hire a good CPA. Things are very, very complicated in our tax system. It's a necessary evil of being a citizen and doing business, but you've got to have good advice, and you need to find somebody who can pay attention to your situation. Keep very good accounting records. Again, things are complicated if you are examined, and the examination rates, certainly from the IRS, are going up. You need to have good records. File your tax returns timely. Also pay your income taxes. As it was just mentioned, you don't want the government, whether it be the federal government or the state government, to be a creditor of yours. The interest rates with the penalties are very extreme. Do I have a few more minutes? Okay. I'll go somewhat quickly. I wanted to highlight a couple incentives because I do believe DC has been very, very business friendly. A couple, I don't think you mentioned this too much, but there is a big incentives for technology companies operating in the District of Columbia. And what a technology company is really an individual or an entity organized for profit that maintains an office in DC, has 2 or more employees, and 51% of their revenues are from technology sources. That's a broad definition. I don't want to get into the details now. But if you operate a business like that, significant DC corporate tax credits for employees hired and for relocating employees into the city, if you reimburse them for their relocation costs. It can be $5,000 per employee that you hire. If they relocate into the city and their principal residence is either acquired or rented, it's $7,500 an employee. These are income tax credits that offset your DC corporate tax liability. If they're not able to be utilized currently, they can be carried over for 10 years. If you happen to be in a high technology development zone, there's a 5-year abatement of your DC corporate income taxes. If you're an unincorporated business, there's an elimination of your DC unincorporated business tax. And then also, I think it was mentioned before, but there's certainly a reduced or elimination of other taxes such as personal property, real estate taxes, and sales taxes. It was probably back in the late 90s that this concept of enterprise zones in the District of Columbia came about and offered significant incentives for people. One of them that still exists, well, all of them still exist, but one that we have found very popular with many of our clients is a wage credit that is taken on your federal income tax return. If you're operating in an enterprise zone, and there are many enterprise zones in DC, and it's based upon census tracts and income levels of people in that zone. If you employ a DC resident and you operate in that zone, you're entitled to a credit equal to 20% of an employee's wages up to $15,000 of wages, or a $3,000 income tax credit versus a deduction. That saves people close to $2,000 per employee. And I can tell you on a lot of our construction clients, it's significant savings. Other things resulting from the enterprise zone were the easy bond financing. We mentioned earlier the TIF financing, which is for really big projects that have a significant impact on the community. The easy bonds are not quite as difficult to qualify for, but offer significant lower cost financing options for businesses. And then finally, the last federal income tax credit I'll mention, if you're a first-time home buyer in DC and you file a joint return, if your income is less than $130,000, that's your adjusted gross income, you qualify for a $5,000 federal income tax credit. These are reported and the taxes are saved on your federal tax return. Thank you. I'll be happy to take questions afterwards.